taking a minute. Oh, we're live. Hi, Chon.
We're
Welcome
live.
to we're live. Welcome
Amazing.
to Venture with Grace.
Thank you for having me. I'm excited to be here. And Grace, if I could ask a dumb question, can I just
Okay, yeah.
share this link as well for people that want to join us live?
Yeah, for sure. I think let me see if you're already sharing this. Maybe it is auto shared. I'm sorry. I'm like very bad with like technology, although I feel like I talk about technology every single day, but I feel like a fraud. But oh, why is this not there? Yeah, like let me just quickly, yeah, I think you can share. Let me just be like how do I share this actually? Um sorry, I'm like trying to figure out like how do I share.
No
I
worries.
think I think you can just share the event. Once you share the event,
Yeah.
let me send you the link of the event so
Oh, I
that
love
way,
it. Thank you so much.
yeah, so that it's shared. So people can like actually when you're streaming, people can just
Yeah.
start asking questions.
Oh, I love it.
Um Let me just quickly share this. Okay.
Yeah.
Let me send you. Oh my god, it's like I'm seeing myself. This is so weird. Sorry.
Echo.
Okay. Yeah, I
Did you send to me
just
an email or?
no, no, no,
Oh, I see it. I
from
see it. I
private
see
chat.
it.
Yeah,
I
yeah, yeah.
love it. Thank you so much. I'm gonna
I
share this with you.
apologize. Yeah, like
Don't
oh my
apologize.
god.
This is great. Okay. Yeah, I'm sharing this with folks that might be interested in joining us, and thank you for having me.
Thank you. Okay, so who is no, I don't think like okay, so someone trying to join us through the backstage. So
Oh, sorry. Ignore that then.
okay,
Because
yeah, yeah, yeah.
I might have
Okay.
shared the other link by accident.
It's I sent through the private link, the
Okay.
private chat.
Yep. It's
It's
the LinkedIn events is
event.
the one.
Yeah, yeah, yeah,
Yeah.
correct. Yeah, if
I
we
I get
share,
it.
I saw immediately someone join the
My bad.
backstage.
My bad.
I feel
My
bad
bad.
for that person.
No, yeah,
Uh,
that's okay. No worries.
okay, perfect.
Yeah. Um. So when you start the live thing, I think the live thing is very cool. Very
I
interesting.
started actually at the beginning of the year, so
Mm.
maybe like the second week of January, and start going live every day on LinkedIn. So it's like
Oh,
pretty
amazing.
intense. Are you taking a
I
screenshot?
am because you know what I mean. I mean, sometimes technology is hard.
I feel you. Um, I like that you're taking a picture of the backstage.
Yeah. Okay. I'm
Okay,
good.
perfect. Okay, awesome. So to start the show, I would love for the audience to learn more about you. So obviously you have done that like a hedge fund yourself, and then like you have from our last chat you have like worked in China for a while. So like to give the audience a little bit of like TLDR on your background, why don't we start with like maybe you started your career as a student at Berkeley, and then you went on to work at like Microsoft, Intel, and maybe we start from there, and then before we jump into your founder journey.
Sure. Well, I mean, I think the short version is I have had very little structure in my career. I seem to fall from one one interesting project to another. I've been very blessed professionally, but almost none of it has been planned. um, but yes, I started at Berkeley studying EE and computer science. I went to grad school at MIT. I was a very typical engineering student for that era. This is the pre-dot-com era where all I wanted to do was write code and eventually find a big company that would give me a job for 20 years, right? That's all we had thought about. And then the whole dot-com thing happened. It really changed my perspective. I look at the students now, and we have high school kids that are launching startups. We have freshmen, sophomore. They're all coming in with ideas and a code base already written, and it's amazing. When I started out, I mean, I got to senior year of college without knowing what a startup really was, and the first time I heard of someone turning down an offer from a Microsoft work for a small company, it was shocking to me. It was like, wait, why would someone choose to do that? That doesn't make sense.
I feel you. Um, I wonder, I have a couple questions there. Like
Yeah.
one thing is like since like you started Berkeley SkyDeck, so at this
Mhm.
point like they already have a accelerator running, which is like pretty successful.
Yeah.
And like one thing from our conversation that kind of like um surprised me is like I feel like, you know, you quit running your own like successful like trading
Hmm.
program to
Yeah.
this. I feel like there's a lot of differences between like trading program, which is like you are leveraging code
Hmm.
to kind of like make investments in the market, which is like very qualitative, and versus like I feel like the startup
Yeah.
investing ecosystem is a lot of it is like based on like your belief in a certain founder or like a lot of emotion going on in the or like I guess like more of like a human interaction in that space. Like what how do you kind of like deal with that transition, and like how do you kind of leverage your quant background to start
Yeah.
Skype?
So as I warned you, my career has been very not designed, not very structured. So it's really been a function of falling from one thing to another as my interest, as my intellectual curiosity brought me in different directions. So my quant fund, which I started in the 2008 financial crisis, was really um, born out of intellectual curiosity. Like I hadn't worked on Wall Street. I had a background in quant finance, but not in a formal institutional way. I had no idea what I was really going to be doing. I just knew that I could write code that exploited an edge from an asset class that was not priced correctly. And it turned out, and I mean, this is something that just I think makes sense to all of us. It turns out to be very successful. All you have to do is find something with a small edge and do it a lot. Okay, and this is also a concept that I had drilled in my head from my early days at
Mhm.
MIT. Do you remember that the movie? Is it 21? Is it Black? I don't remember what the movie was, but it's based on a true story. It's about a group of kids from MIT that went to Vegas and would count cards and won hundreds of thousands, if not millions of dollars over years. Are you familiar with that story?
I don't I'm
Oh,
not sure, but I do know a lot of, like, really smart people, like, playing poker or something becoming, like, super successful.
it wasn't. It was more quantitative than poker because poker is really a game of a lot of luck.
Mhm,
At MIT, there was a team. I mean, there was an actual team that was co-led by a faculty member and some very precocious grad students that statistically figured out how to beat the odds and how to win money if you bet at the appropriate times. It was a minor edge. We're talking about, 50.5%, right? Instead of a 50-50 bet, we're talking about
mhm.
50.5. But if you just take that 50.5 edge and you do it 1,000 times, you're going to make a lot of money. So that was the same model for the quant fund, right? That was the same thing. I had something where I knew that I had a slight edge, and all I want to do was just do it a thousand times. Fast, and I'm telling the story because it really applies to why I ended up here. Now, I left the quant fund not because of Skydeck. I left the quant fund because the quant fund was destroying me emotionally and physically. It was for people who have not been in that. If I ever talk to anybody who's been in that industry, they immediately smile and nod and kind of like, oh yeah, no, I know exactly what you are talking about because that career is just, the amount of trauma that it inflicts is unbelievable. But I started the Skydeck journey because for a similar logic, I realized that there was something here where we had an edge, and I wanted to take that edge and do it a lot. And I knew that would translate into a very successful fund, a very successful program, and that's where we are now.
I want to kind of, like, double click on something, you just said about, like, the edge, perspective. I think, like, you know, I know that you mentioned about this on another podcast, like, when you guys first started, Skydock, like, you were thinking maybe this will be just, like, a small fund because of, you know,
Mhm.
every school has a accelerator these days, and then, like, it's harder to stand out, and like especially, you also went to MIT, and then I feel like MIT also have like really strong technical talent bench. And I wonder, like, what do you feel like it was the differences between like SkyDeck Fund versus like if a top school just started something on their own?
Yeah, I mean, I'll start with a by observing a fact, and then we can try to like figure out what's behind that fact.
Mhm,
The observation is that there are lots of top schools in the US, around the world. You just named
mhm,
two of them, but I can give you a whole bunch more, right? CMU, Georgia Tech, UIUC, UT Austin. These are all great engineering schools that publish great papers, do great research, and pump out talented people every single year. Um, all of them have a accelerator. I mean, all of them have more than one, right?
mhm,
And how many of them have a fund that is of a certain scale, that is successful, that is backed by financial investors? Very few. The only one that I know of outside other than us is really MIT. They have a platform called the Engine, which I also love, uh, by the way, but they're focused in a different direction, really focused on deep tech, and they also invest in a different way too. But the bottom line is, of the other hundreds of departments and labs around the world that you can easily name, none of them have been able to raise a fund, and it's not because of a lack of trying. The reason is because you don't have an edge. When you talk about the financial markets, it's funny because when we go to our founders, what is the thing that we tell them? You better have an edge. Like if you're going to build a venture backed startup, it can't be because you want it really badly or that you're really smart. It's got to be like, what is your competitive advantage versus all the other logos on your chart, right? I mean, there's
mhm.
a lot of logos. What is it that you uniquely do well that no one else does? Well, un- unfortunately, many VCs don't ask themselves that question, and certainly a lot of these accelerators don't have, at least maybe they've asked themselves that question, but they don't have a good answer to that question. So for me, the reason that Skydeck was what I wanted to really devote the rest of my career to, the reason that I got so excited, and the reason that we're scaling up so quickly. We now have $160 million in assets under management. We're going to raise another 100 million this year. I mean, we're really on a, well, I don't say it's a rocket ship because that's exaggerating, but we're doing very well. We're doing it in a very scalable way, and it's because we have a real edge. And is this a good time to talk about what the edge is, Grace?
Please do.
Okay, yeah,
This is the perfect time.
yeah. The edge is, so if all we did was tap into the brilliant people at Berkeley, I don't think that's enough of an edge. MIT has brilliant people, CMU has brilliant people, etc. The edge is, we've learned that we can turn Berkeley itself into a incubator, into a place to build a company. Okay, so think about what I just said. We're, instead of being a accelerator attached to Berkeley that helps pull things out, we're helping turn Berkeley itself into a accelerator and bring people in. So we want the world's best founders, and I really say the world because there is a strong, strong, strong emphasis on global founders, on founders from outside of the US who have drive and energy and skills and talent, but just don't have access the way that we take for granted here in the Bay Area. We want them at Berkeley. We want to plug them into all of the resources at Berkeley to help them get to the next level. And no one else can do that the way that we can. No one else has the roots that we have in Silicon Valley. No one else has 500,000 alumni in Silicon Valley. Our alums, we have Gordon Moore of Intel. We have the founders of Google, not Sergey Brin, but Eric Schmidt. We have the Woz from Apple, right? I mean, like you go, we have Mark Tarpening at Tesla, who's one of our current founders. You go up and down the line, and all of the top companies in the valley have deep, deep connections to things that are occurring at Berkeley. And I'm not saying that that means I have to invest in the next company coming from Berkeley. Of course, we're going to try to do that as well. But what I really think is that I don't think that's an edge because everybody's aware of that. I mean, I assure you, all the big funds are walking the walls, walking the halls of the computer science department at Berkeley, trying to find the next dinner bricks. Everybody's doing that. But what we're the only ones that are doing, and we're the ones that are capable of doing this, is if you're a brilliant founder in Germany, in Chile, right, in Hong Kong, we want to bring you to Berkeley to connect you to the researchers on campus, the business school on campus, the 500,000 alumni, and then we'll help you raise. We have 600 investors that come to our demo day because they know us, they know our brand, and also because we're close. Right? So that's Edge.
I wonder, so like how is, so since like we have chatted about like, I feel like you guys have absorbed a lot of like the words talent, and like how is a incubator or like accelerators structured to help the fund and vice versa. And I know you have like a pretty back in, I don't know if this is still true, but like um on your interview with someone else, like who, like maybe like a couple years ago, you guys portfolio construction was more fairly like concentrated, called like 20 company and a fund or something at the like at the earlier stage. Can you chat a little bit more about like the selection process from the successful accelerator to eventually end up at the SkyDeck fund?
Yeah. So the strategy hasn't changed. So anything that you heard was probably just I probably just that didn't explain myself more clearly. But it's actually been surprisingly consistent. Like when we started this in 2018, I actually left myself a lot of room to wiggle and to pivot because I didn't
Mhm.
know what would work. I didn't know if we'd be any good at this. I didn't know we'd be any good at convincing founders that we'd be good at this. I didn't know if investors would think we were good at this, you know? So we were prepared for all kinds of contingencies. But the truth is, like the program that we launched, the type of companies that we launched, the way that we invest has basically remained the same for the last 6 years. Yeah. So what is it that we do? Yes, we do 2 batches per year, 6 months long, not 3 month long. You know, we call ourselves an accelerator, but I've really a lot of times I said I feel like we're closer to a venture studio in a lot of ways, because we are not just about coming in, let's polish up your pitch deck and let's go. We're we're gonna work on building your company. Like if you come here, expect a lot of brainstorming, a lot of pretty harsh or blunt discussions about like what we're building and why we're building it, and then giving you time to go back and think about it and work on traction and come back and to evolve. We want to, in terms of the verticals, we want to do anything that we think that A, Berkeley is good at, and B, VCs want to invest in. Those are the two filters. Right? What is Berkeley good at? Berkeley is amazing at deep tech. So that continues to be a very strong field for us. You know, if you're building a social app, um, it's not that it's not a fit. I mean, we've done some and they've done well, and I'm sure we will do more. But like a consumer facing product, it's all about execution. It's not such a natural fit, right? Like I don't know how we can help you. Maybe that's the better way of describing it, right? Like other than help you fundraise, how much value are we going to give you as the venture studio part of things? But when you're working on a a dev tool for fine tuning your LLM, when you're working on a new semiconductor, when you're working on robotics, new chemistries for batteries, um, this is the kind of stuff that we do all day long, and we can help you so much. We can help you first of all refine the product with the support of campus, but we're also gonna just help you tell the story better, right? Like to have a Berkeley faculty member on your advisory board, guess what? Like investors are gonna find that way more credible than two PhDs from a school that unfortunately they just haven't come across before. You know what I mean? So that those are things that we think about. Roughly 5% of the portfolio is probably biotech. Another 10% like is in digital health, med device. Another 10% is in semiconductors. Maybe another 5 to 10% are like in robotics. And then but the bulk, like 50%, 50 to 60% um, of the portfolio is probably going to be more or less standard enterprise SaaS, but enterprise SaaS where again we think that technology is a difference maker.
I wonder, so like, can you unpack a little bit more of like the structure of the 6 month two badges, and then what was a selection process? So I'm familiar with like some of the accelerator would be like having the VCs come in and then pick like who have like a better chance to succeed, and then bring them into the accelerator, and then eventually accelerate them to growth, to a certain stage where the VCs are comfortable to invest in. Like, do you use like a similar selection process, or like how does that kind of like differentiate it from like like a YC or like Founder Sync or something?
Yeah. So we don't do exactly that because we don't want to be captive to a specific group of VCs. So folks might be aware of this, but on day one, we were actually the first fund where we got our money to invest people
Mhm.
actually came from the best VCs in the valley.
Mhm.
Sequoia, Mayfield, Sierra. These are funds that invested in us, not the partners. The funds did, um, and there we would work with them on deal flow. We would, ask what they wanted to see, and we'd be very involved in having them help us sort of guide some of the thesis that we want to invest in, and we continue to work very closely with all of those funds. But there's 500 early stage seed and A funds in the valley that lead rounds. Um, and I think the only way to be successful is to, of course, we have to know what those VCs want to see as a category, but we don't want to be captive to their specific opinions, right? Um, Now, what we do is from a selection process perspective, I'll walk you through it. So we roughly have 2,500 companies that apply each batch. From the 2,500 that apply, we're blessed with some of the best advisors on the planet. We have 60 or so that will take out their time to help us evaluate all 25 pitch decks. Sorry, 2,500 pitch decks. That takes a lot of time, as I'm sure you can imagine.
Oh, you mean
We're playing
60 investors or 60 people in general?
60 advisors.
Okay.
Advisors, a lot of whom are investors as well. I should mention.
How do you think of like the 60 advisor um as like, I guess like how does it, do they like each pick like because you mentioned like it's about like 2,500, so let's call it like each person do like call it like 400 companies, or like how does it work?
Yeah,
Like 40 companies, sorry.
yeah. So what we really want is each of the 60 people are gonna see many companies, many more than 40. I mean, there's a range. Like some are a little busier, maybe they only see like 30, and we know they're experts in fintechs. We'll only send them the fintech ones. Some are more general, and they'll see like 200. I'm I'm gonna see like 500 to 1,000, and I make sure I certainly make sure I see all the ones that are sort of on the edge of making it to the next one. So from the 2,500 through this online passive screening, we're trying to get to about 150.
Okay, I guess like what if let's say if I'm a fintech expert and then I get
Yeah,
like a fintech deal, like
yeah.
and then that's kind of like also personalized opinion. Like let's say
Oh
if
yeah,
I'm the founder of
subjective,
Stripe, yeah,
very
and then
subjective.
I
Yeah.
would just pass on every Stripe potential threat. But like I wonder how do you kind of see like how are they incentivized to like
Yeah.
make the best judgment for the program?
It really is the wisdom of masses, the wisdom of crowds. We're not depending on this one person. Like every company is going to end up with 5 to 8 people who have given it a score. Okay. And we do track this over time. Like if some advisors we thought were scoring in a very odd way, where the data shows that their opinions are in conflict with most other people, we're going to either counsel them or we're going to teach. A lot of times they just don't know what we are looking for.
Mhm,
So when we score, there's 4 axes that we score on, right? Like team, market, traction, and then sort of overall fit for us. This is just a 1 to 5 scale.
mhm,
I mean, like it gets much more detailed, but I'm saying at this stage, that's it. You have 4 buttons that you click, and that's it.
mhm,
Um, and we explain to people that only 150 out of 2,500 are gonna make it to the next level, right? So if you believe that the company that you just saw is one of the best 10%, right? You should make sure that it's getting scored at probably a 3.5 or higher on that scale. And if you feel otherwise, score it differently.
mhm,
And then at the end of the process, what we often see is the top 100 is just like indisputable. The top 100 is a no brainer. Like we like, oh my god, everybody gave them 4.0 or higher. They're going to the next round. The next 200 are like in that 2.8 to 3.5 range, and it's like, we really need to better understand what's going on there, right? So that those are the ones that I really have to spend a lot of time on. We really will bring in additional people to study it, and then we have to get it down to the top 50.
I have a question in there.
Yeah.
Like, so we're talking about the fund on the fund level here, right? Not like the accelerator level or
Oh,
like the
I mean, it's the
accelerator.
same thing. I mean, we
Okay.
are we are really hand in hand.
Plugged in to
This is
each
the
other. Yeah.
In fact, I should clarify. The selection process is run by SkyDeck.
Mhm,
They're the advisors, they're SkyDeck advisors. They're not fund advisors, they're
mhm.
SkyDeck advisors. The selection process is not the fund's selection process, it's SkyDeck's selection process.
I wonder, so, like, since, like, I see a lot people list, like, SkyDeck as their like, they went through the SkyDeck program, and but, like, I assume they're mostly probably not invested by SkyDeck, so, like, if they went through the program and then didn't really get a check, would that send, like, a negative signal to the ecosystem?
Okay, so to clarify, and I'm really glad they asked that because there is a lot of brand confusion out there. SkyDeck does serve multiple roles. Okay, it has an educational role, because it is a part of campus, right? Like
Mhm,
the taxpayers of California are in effect subsidizing the operation of this whole thing, right?
mhm,
So we have to serve the taxpayers of California. So um, we have a program called Pad 13, which is more of an incubator, which is sort of like co-working advisors that you can call upon. We're not investing in you. There's like 80 to 100 of those at any given time. It's only three month long. It when I say you're in SkyDeck, when I talk about the cohort, that's not the Pad 13. Pad 13 is sort of the farm team. We're hoping that they get there. We're going to support them. We hope they then apply for cohort. The selection process that I was just starting to talk about, that's for cohort. That's just for cohort. We're going to end up with 20 cohort companies every 6 months, and we invest in every single cohort company.
okay. Totally. So I wonder for so since you mentioned about like there's like four major selection criteria, I would assume it's like the team, the market, and maybe like some other factors. So I wonder what would be the specific checklist that would be like surprising to people. That's not like the
Yeah.
generic. Is this
Oh,
team good?
oh, surprisingly, people. Oh, okay. Yeah, because I was gonna. I mean, first of all, I wish it was a checklist, because then we just give this thing to chat GPT and be done with it. um, it's much more subjective in a lot of ways, and that makes it harder. But here's one that is perhaps surprising to people. One of the most important questions for me is, why Skydeck? Okay, so
Mhm.
if you come in and you tell me an amazing story about traction, revenue, everything's good to go, we have it all figured out. It's like, why are you raising 200K from us? Why have you not already raised? Right?
Mhm.
Like, that's a question that I'm gonna make myself ask. I don't believe in um a free lunch, right? So what's going on? The right company is the one that says, we have all of this figured out except for this thing, right? Except for this one thing. And that's why, bless you.
Thank you.
And because of the absence of that one thing, investors don't want to invest in us, or we can't find customers, or something. And I'm looking at it and I'm saying, okay, that's like Skydeck fits that thing
Mhm.
well, right?
Mhm.
Like, if you're lacking traction, like, you believe that you have a product, and you can explain to me why customers want your product, but you just
Mhm.
haven't had enough customer conversation because you don't know how to do the go to market piece, where you don't have enough warm intros into your target
Mhm.
customer. It's not easy, right? Like, I mean, a lot of very experienced salespeople get paid a lot of money to do nothing but to contact the right customer. And an engineer who hasn't done that before, or a researcher who hasn't, it's not easy, right? So you don't know how to do that. We know how to do that.
Mhm.
Um, when a founder comes in, is brilliant, and has a horrible pitch deck, I get excited because I'm like, I get it. That's the gap, right? The gap is, he has no idea how to fundraise. We can fix that, right? So I want imperfect fruit, for lack
Mhm.
of a better word, but it has to be imperfect fruit that Skydive can be a good fit for.
I wonder, since you mentioned like Berkeley is very good with like deep tech, and like what would be the most frequent question these founders would ask SkyDeck to help with? Is that like, how do we raise funding, or is this like branding, or is this more of like, how do we get our first client, finding product market fit? Is there like one specialty area that you feel like,
Yeah.
oh bam, like, if you come to us, we'll make you like the next Tesla or something?
So when they come in, I can tell you the first thing they think they want investors, right?
Mhm.
They're every founder, maybe not every, but 98% of first time founders think that the magic to being successful in the venture business is just to get an investor. If I only had money, I have it all figured out, right? And the truth is, that's not the way it works. The truth is, if your business was good, people would chase after you trying to give you money.
Mhm.
Right? And I think not enough founders appreciate this. Venture is an incredibly competitive business. I'm talking about not for you, I'm talking about for VCs, right?
Mhm.
VC is an incredibly competitive and challenging business. Um, a, a partner, a general, anybody who's a partner at any of the big funds, they roughly have 3 to 4 years to invest in a company that's going to be amazing. And they're only going to have two bets a year, like, they don't get to do a whole lot of deals. So in the first 6 to 8 deals that they do, they need a home run. Okay. And if they don't get it, there's a pretty decent chance that their career is over as a VC. Okay. So they they need, this is not a vacation for VCs. This is not a power trip. This is not a hobby. Like, they're under tremendous pressure to find the right company to invest in. And if they're not investing in you, most of the time, it's because your company is not good enough. It's not because you haven't met enough investors. So,
I
yeah,
would like I agree on like most of what you're saying from like a logical perspective.
yeah,
I feel like I got the so like you mentioned like a lot of people come to you for like funding advice as a like so I have a consulting business on the side. A lot of people are coming in as hey, can you help us I think funding is one of the big benchmark, but a lot of like the founders that are successfully raised and they're
Mhm.
coming to me as like, hey, can you provide like media strategy?
Mhm.
And I feel like a lot of people are thinking if we got enough hype, we'll attract enough capital, we will basically be the next unicorn. I feel like this is like the new kind of like way of thinking to a lot of founders. I wonder what's your perspective on like when you should build up the quote unquote hype and like is that like the right way to approach? Because I personally do believe like if you have a really solid business, you would be able to attract funding. But nowadays, like because of we can see a lot of successful like AI startup that are just getting like tremendous amount of buzz, so they would be able to successfully raise. I wonder like how is like the correlation between like if you can get enough traction that helps you to build a successful business, vice versa.
Yeah. Well, okay. So first of all, there's an expression in Chinese, right? Like
Mhm.
if the forest is big enough, you'll find all kinds of birds, right? So in venture, every kind of deal happens. Like there are people who walk into a bar and have a casual conversation with someone next door, and they turn out to be an amazing business, and they write a term sheet on the back of a cocktail napkin. Like I'm sure that happens occasionally. Don't get me wrong.
I think maybe 10 years ago, nowadays people don't go to bars anymore. They go to Joe and the Juice, but
Or you hear about people being pitched on, you know, in the Uber, right? Like by the time you get off the Uber, you have a
you
term
roll
sheet.
that check. Yeah,
Yeah.
yeah, that's
Uh,
crazy.
so I'm not dismissing any of these stories. Hey, if you want to chase the one in a thousand, shot, go for it. But I, as someone who does this day in day out, we've now invested in 260 companies. I've personally, and like there's not one seed round that I'm like not in the loop for, like very intimate loop for. So I've sat through, I don't know, doing the math, 120, 140 seed rounds, and probably, you know, 40, 50 A rounds. You know what I mean? Like I've seen this, and I'll actually give you a couple more numbers. So for the 20 companies that we bring in, on average, they're going to get about 40 investor introductions. Like I'm talking about like partner level
Mhm,
with funds that lead, which is a very important distinction. Not nearly enough founders understand this. Okay,
mhm,
like if you're gonna raise from someone, it has to be an investor that's at the right stage for you. Like if
mhm,
you're a seed, you're never going to convince someone who's really more comfortable at the A to invest in you. Like it's so hard, right? And you also need to understand that if you're talking to someone who's not comfortable leading, they don't write term sheets, they don't know how to do that type of due diligence. No matter how attractive you make your business, that person's not going to invest in you. So you need for that first term sheet, it needs to be a someone who's happy writing seed checks and who's happy leading seed rounds. That's who you need to see. All right. Anyways, we have 400 or 500 that we work with very intimately. On average, each of our companies will meet around 40 of those. Okay, and these are double-sided opt-in. It's not like, hey, meet Bob. It's like, hey, Bob, do you want to meet company A? Oh, you do? Great. All right. So we arranged 40 of those for each of our companies. I do not believe that the pain point is around making meetings happen. I understand for some founders who are not in the circle, getting that conversation is incredibly hard.
mhm.
Um, but if you get in the circle, going to SkyDeck is one way to get in the circle. There is no fund in the valley that I cannot get to take a look at your company. Okay, like you name the fund, you name the partner, assuming it's a fit, right? I mean, like
Yeah, yeah, yeah.
um, and I can get that a partner at that fund to seriously evaluate your company. It's not hard. The hard part is after they evaluate, they sit down with you for 30 minutes. Are they going to move to the next stage and the next stage and the next stage? VCs usually invest in something like 1.5 to 2% of the companies that they meet, right? Um, as I said, like you look at the daily calendar of one of the partners at these funds, all, they spend half the time in board meetings. They spend half their time doing nothing but meeting founders. So they meet hundreds and hundreds of founders every single month, and they can only make one investment every quarter or one investment every 6 months. You know, you have to be the best company that that partner saw in the last 6 months for them to want to invest in you, right? So it's not about having the conversation or getting the intro or trying to get in front of them or getting hype or whatever else. It's making your company really damn good.
I wonder, so like what if so like you mentioned a lot of 40 different intros, right? So
Mhm.
like after, oh, by the way, hi Gil, like I want to quickly say hi to the audience. He said you're awesome. And like I wonder when it comes to like making the 40 introductions for the 20 companies, like do they all came at once? Because of I would imagine your schedule would be a little bit crazy if you intro 20 company
Yeah.
to 40 investor each. That's a lot of investors, right? And then for the people, like I feel like a lot of the founders like um on the internet would be like, hey, can you introduce me to, here's like 6 people on my podcast. And like I wonder what's your thought process on which investor to introduce to which company, since maybe you have like a bit of like overlapping companies within like the same batch that you may be like sending to the same investors. And
Yeah.
what's an investor's like evaluating process that you have heard the most, like not process, but like what are the most amount of feedback that you feel like are blocking the
Mm,
investor to move forward?
yeah. Okay. So we absolutely are dumping all of these investors on our founders at the same time. Absolutely. Because that's actually fundraising 101 as well. Because the truth is, and um, a lot of the founders at SkyDeck have heard me talk about this. Like VCs have no incentive to invest in you today. Okay, like whatever your story is, like let's say they love you today. If they can just wait another day, you're either going to have more good news, like, hey, I just closed another customer, or you'll have some bad news. I just lost a customer. No matter what, their investment just got de-risked a little bit. So why would I invest in you today if I can just wait another day, another week, another month? The the only forcing function that you have is competition, right? Is I'm gonna the FOMO of, oh shoot, I'm gonna lose this company because they're talking to two other investors and they just got a term sheet. Of the 100 plus seed rounds that I've seen, the most common dynamic is nobody gives a term sheet, nobody gives a term sheet. Oh, here's a term sheet, and now there's five. You know, like that's just what happens every single time. Okay, so if you are just, I'm going to pitch an investor this month, I'm going to pitch another investor this month, you're never going to. I mean, first of all, it's a massive distraction, and it keeps you from building the company that we just talked about, right? Because that really should be your first priority. But it also means that there's not a forcing function. So whenever you're about to raise, you have your list of investors, or if that's how you're doing it, you have people who are lined up to do warm intros on your behalf. You have us. Now you have a 3 to 4 week period where you hit it hard. You hit it extremely hard. You meet everybody within that time frame. You tell the story. It either works and you raise, it doesn't work, which might mean a couple things. You know, it might mean you raise a different type of round. It might mean just keep things going while you keep the current leads like warm, or it might mean you go away for 6 to 12 months and then you come back later. Like I've seen all of those things, of course. Um, but yeah, so I mean, we have had companies that have 100 plus partner pitches in the span of 3 weeks at Skydeck. You know, so just and that's the first meeting, 100 like first meetings, and then you figure. 30 of them get the second, and then 15 of them get the you know what I mean? Like
Mhm.
it's a it's a lot. What
I
was your second question? I forgot what your second question
Oh,
was.
um, I wonder, like, what is, like, a feedback that
Oh yeah,
investor are likely to it's, like, a common thing that you feel like people are getting from the investors if they don't really move forward? Or, like, what is a percentage that if people just move forward with the investment? Because I feel like since each investor are viewing thousands of DAC per year, sometimes
oh yeah,
per month, and, like, they eventually invest in, like, 4 companies. So
yeah,
I think, like, by the time that you after your big launch, like, you reach a certain investor, like, they may already kind of, like, I don't know, like, I think the passing rate would be lower than the accepting rate, maybe vice versa, but, like, I I wonder what's your biggest observation of, like, people are doing right or wrong in these, like
yeah. Okay, so I'll give you the numbers first. Okay, so because we see all of these rounds happening,
Mhm,
so we can track them that way. So after the first pitch, I mean, getting that first pitch is not necessarily easy because
mhm,
VCs are bombarded and they have to be selective. Like they already know I'm only going to invest in 2% of the deals. Please let me try to get as close to get that number as high as possible, right? So they don't want to meet founders. It's very rare. Most VCs don't really want to meet cold in bounds or anything else. But they saw your deck, they saw your board, like, I want to meet this person. They meet you. Roughly 20% of those will get to the next meeting. Okay. Um, there's a pretty wide distribution there. Some are as low as like 5, some are as high as like 50, but it's something in that range. And also a tip for founders, if you can meet the investor in person, please meet them in person because that has a massive impact on that conversion rate. You really want them to see your passion and your energy and you know feel your presence, not just through your computer screen. Um, so 20% roughly gets to the next meeting. And then from there on out, every subsequent meeting, you're talking about like a third to maybe half. So if you can get to 5 meetings, and this is also something that I advise our founders, like for an institutional VC, it's very different for angels, but for an institutional VC, you're just pushing for the next meeting because if they're spending time with you, it's because they're
mhm.
interested. It's because they're seriously interested and they're trying to answer some question in their head about your business, but they're interested. And yeah, so just make sure that conversation is warm. They're getting the answers that they want, etc., etc., etc. What are the reasons that people don't invest? I mean, like long list, right? I'll tell you about some of the ones that most founders don't fully recognize. Like when founders come in, I have to sort of erase their memory and be like, here's forget that, or like we have to do this very differently. The first one is probably TAM. Okay, like the size of the market. A lot of people come at it from the position of I know this business can work. Like of course, right? Like if you don't think a business is going to work, you're not going to spend your life trying to build it, are you? But the fact that you think it's going to work, the fact that you would use it, or the fact that your target customer would use it, is a great start. But investors need a massive market now. Then, and this is different from where it was 10 years ago or 20 years ago. But when you look at a billion dollar fund that really like drives so much of the action, especially at the later rounds, they need billion-dollar, tens of billions of dollars um, exits to justify the size of their fund, to justify their business model. And so they're just not going to invest in you if you max out at 50 million in revenue, right? And and then the founder go, but no, I have a really high probability. Like I'm really good. I'm gonna get to 50 million. It's not 50 million. It's not a pretty good outcome. And the sad truth is, for a VC, the VC that only gets to make 2 bets per year, 50 million is not good. Even if you said, I guarantee you, I'm gonna make 50 million next year, the VC is gonna see that as a bad bet. Okay, They would rather take the 1 in 100 shot at getting to 500 million than the guarantee of 50 million.
I wonder, I feel like a lot of the company would start as like a really small project and then eventually they become like the solution for everything. Like, Uber started as a black car but eventually became like everyone's, like, I don't know,
Yeah.
like taxi basically. um I feel like it's really hard when you're um evaluating based on the market that like a person would just tell you on the first bat. And like, I wonder when it comes to like SkyDeck fund, and like what would be your like answers to the founder or like helping them to navigate that situation, because I kind of feel
Yeah.
like that would um be, I don't know, like shortcutting some of the founders who are very talented.
No, I mean,
I think it's kind of like really interesting because nowadays, like people from like, I've chatted with a lot of emerging managers. Everybody have to have a niche, which is like the edge that you mentioned. Like, there's a really small niche that you're dominating, and then
yeah,
you maybe explore like other niches or some other
yeah,
stuff. But like the problem is like, and then if in the VC world or like in VC investing in startup world, like people would think, oh wow, that's so small. Like, you're only solving a really small group of people's problem, like this is not big enough, blah blah blah. But like, how would you kind of like advise people to go dominate a niche versus like
yeah.
just say they have like a really big market?
No, I mean, I completely understand the confusion because those two things, like, they feel like they conflict. But here's the way to think about it. To build, to be successful as a venture-backed startup, you need to win today and you need to win 10 years from now. Okay? Like, a VC is not going to succeed if you don't have the market size that I just talked about. Like, if you max out at 50 million, the VC will, the partner who made the investment will feel like it was a failure. That's the bottom line. But you're not going to get there if you don't win today, right? Like, so those two pieces of advice, they're not in conflict. We have to start with a small wedge, some segment of the market that loves your product, right? That has a, because you're building a product that obviously doesn't exist yet, or you're trying to displace a solution that currently exists, right? You're not doing that unless you're 10x better. And you're not, and I don't really believe, well, at least it's much more difficult to build something that's 10x better for everyone. But for you to pick out like some small segment, like, you know, red haired, um, 30 to 45-year olds who run gas stations, right? Now, can you build a solution that's 10x for that person? You have a shot. You really do, right? Um, so you have to start somewhere. You have to start with the wedge, and then you can have a story, and you have to tell the story. You can't just be like, and then I'll figure it out. No, you have to say, here's why. Once I have that segment, it's going to be, my strategy is going to be expanded in parallel. I'm going to start with the red-haired ones, but once the red-haired ones are using my product, the blondes that work in the same gas station will also see it, and now they'll be more inclined to use my product, right? So you need that land expand as one way of thinking about it, strategy for growth. But ultimately, you still have to get to that massive win. And there's actually only so many ways that you can get to the massive win. Like, you need to have a moat. I'll give you another example. None of founders think about life, like, founders are thinking about life tomorrow. Of course they are. Like, they spend all their time thinking about how I'm going to get my first customers. Thank God. They really have to. Some of the best founders also think about life 10 years from now, right? Like, I'm going to build a marketplace. I'm going to have an edge on data. My model will be the best on the planet. They have a theory on how, like, they win actually at 10 years. But we need even more than that. We also need a story on how we're going to win in 3 years. And why is that hard? Well, let's think about it. In 3 years, if you've done well, you have 5 million in revenue. right? You've just closed like 10 million or 20 million in your most recent round. Everybody in your target segment now knows has heard your name, saw you on TechCrunch or something. Guess what happens? Now there is 20 companies at SkyDeck and LYC who are taking your product, who are tearing it apart, who are looking at your customers going like what is it that they're doing not ideally, right? Like, can I copy every single feature that they have? Of course I can. And then the one feature that they're not doing well, I'm going to make that my wedge, and I'm going to go after that segment, right? And now your pricing power is gone. Now going from 5 to 10 million is actually extremely difficult. So the truth is, like, to be successful in this, it's like playing football. You have to win on offense, on defense, and on special teams. You can't just be an amazing at one thing. You have to nail all three pieces of that company's growth to really convince an investor.
Mm. I wonder, so like since like we chat a lot about on the founder end, and I want to be mindful of the time. I don't know if you
Yeah.
have like more time.
You run
But
pretty good. Yeah.
I why don't we end with like a 1 minute fire round? Although there's still, I'm sure the audience have questions too later on. But let's start with like, what's your favorite book?
Sorry, my favorite book. Oh my gosh, um, Red Rising. It's sci-fi fantasy. It's sort of like Roman mythology set in on Mars. So, Red
Oh
Rising.
wow.
Yeah.
Who made the biggest impact in your career?
Oh my gosh, who made the biggest? I'm going to say Caroline Wynette. I mean, she's the executive director at SkyDeck. Um, to be honest, if you go back 6 years, I didn't know that our partnership would go as well as it's gone. She manages everything on the campus side. She manages the politics. She manages the board amazingly well. She's a great leader, and yeah. So
Amazing. Who made the big? Oh well, who would you invite to your dinner party?
who would I invite to a dinner party? I would love to oh gosh, that's a good one. Um, I'm a pretty big fan of geopolitics. I follow it pretty closely because obviously it affects all of us. So I would love to have a dinner party where we could put away the cameras, get away from all of the press, and really have a heart to heart with all the folks that drive what's happening in the world today. So Putin, Xi Jinping, Biden, or is it Trump, or is it Harris? Like really be able to figure out some things.
Some things.
Yeah.
uh, where can we find you outside of work?
I'm always working. No, I
Oh
mean,
God,
I like to travel for fun. In the last few years, we've been everywhere. We've been to Istanbul, to Tanzania, to Ethiopia, to Indonesia. Like, I do like to do a lot of traveling, so it's gonna be hard to find me in one specific geographic spot. But if you ask people at Skydeck, you'll know that you can always find me on Slack, like any time of day, 7 days a week. I'm on Slack.
amazing. What's your favorite Berkeley company? Like Berkeley alumni company. I wouldn't want you to pick just Skydeck company because it would be hard, probably.
Yeah, in fact, I'm gonna say I'm not gonna pick up a Skydeck company because that would really be painful. My favorite non-Skydeck Berkeley company is probably Databricks. I mean, like, it's such a massive win, and the fact that they were able to do it on the back of an open source project, to me, is also inspirational. Open source software is one of the great inventions that Berkeley is also responsible for, or at least partially responsible for. And I'm grateful for it because without open source software, we wouldn't have the explosion in AI and LM that we are seeing now. the same time, for a company to be able to monetize open source effectively is very important. So win win win.
Amazing. Well, Chon, thank you so much for coming on the show today. It was a fun chat. Again. Okay.
Thank you.
Let me quickly